Coming to the last part of our alternative investments module, that is commodities. Commodities have also evolved as another form of investment under the category of alternative investments. Many investors have or now are preferring commodities as an investment option. Let's understand why. Well, commodities are physical products. Like we know in a general layman terms, commodities are those which have a tangible value. They can be touched, felt, bought, sold, etc. The returns on the commodities are primarily based on the price changes that happen rather than deriving any income out of it, like say dividend or interest. The prime intention of holding a commodity is to buy it at a lower price and sell it at a higher price at a later stage. An important thing to note here is that holding physical commodities will involve costs of storage and sometimes transportation too. So if you want to hold 100 million tons of stock of coal, it will require a huge space to hold that commodity for a period of say 2 months. So maybe you will have to rent a warehouse which can hold this 100 million tons of coal, because you're expecting that after 2 months you will get a very better price for that coal. So there is a storage cost involved and also transportation. So when you buy coal, you will have to transport it from the mine to the storage warehouse, and when you sell the coal, depending upon your terms of the contract, you will have to transport the coal from the warehouse to the seller's premises, to the buyer's premises rather. So some of the examples of commodities are in the energy sector we have oil, natural gas, electricity, coal, etc. Then there are commodities which are in the form of base metals, that is copper, aluminium, zinc, lead, tin, iron, etc. And then there are precious metals, also known as the alternative investment horizons, and they don't have any specific utility value, but they have just the value in terms of precious metals. So unlike copper and aluminum, which are used in many products that we use in our day-to-day life, gold and silver are more for showcasing off in the form of jewelry on yourself. So precious metals like gold, silver, platinum are also treated under the category of commodities. And then there is agricultural items like grains, livestock, coffee, tea, etc. And the other classifications will include carbon credits, freight, forest products, etc. Carbon credits recently have been into huge limelight because of the importance it gets in the overall environmental preservance in today's world. So let's understand the various forms of investment in commodities. How can you take an exposure in this form of alternative investment? First up, you can buy the physical commodity itself. So in case you're buying this with delivery, which is in fact primarily limited to some smaller group of investors or buyers which are actually part of the supply chain. So for example, you are a stainless steel manufacturer, so you will buy iron ore or iron ore pellets because that iron ore or iron goes into as raw material for the stainless steel production. So you are actually a user of the actual commodity. So you may invest in physical commodities like iron. Whereas some of the non-users who want to take an exposure in commodity investments will mostly prefer commodity derivative contracts, which, as it's mentioned, most investors use. So you can get an indirect exposure without having to actually buy the physical commodity. All the derivative contracts of commodities like futures, options, swaps, forwards, they all will specify a quantity, also what type of quality of raw material that or the commodity that you're buying, what is the maturity of the contract, and the delivery location. Mind you here is that various commodities could be available in different quality grades. So there is a coal with a high calorific value quality or a coal with some low calorific value quality, etc. Similarly, the qualities can differ in oil, gold that is 99% purity, 95% purity, etc. So the prices will also vary depending upon the quality of the commodity used as the underlying. Further, these commodity derivative contracts may trade on exchanges or can buy them over the counter like the other investment forms like stocks and bonds also. Or an investor has an option to invest in commodity indices, which typically will use the price of the individual commodity futures contracts to form the index. Or you can have an option of investing in commodity ETFs. So for example, there are various gold ETFs available, silver ETFs available, oil ETFs, or grains, that is wheat ETFs, soybean ETFs, etc. So an example of that is an NSE Gold ETF, which is traded on the Indian exchange and the National Stock Exchange of India, that is NSE. And another option is to invest directly in the equity of the companies which are exposed to a particular commodity. So say if you're buying shares of a company which deals or which is in the business of oil exploration, like a Shell or Gulf Oil, yeah, British Petroleum, ONGC. So all these are the oil exploration companies. So that is direct exposure to oil producing companies. Or you can buy shares of coal mining companies. So Coal India Limited or some of the other big names in this any kind of metals mining. That gives you direct exposure to the commodity. Not direct exposure to the commodity prices, but ultimately the ups and downs in these prices will affect the stock price in a certain manner. So what does investing in commodities entail? So investing in commodities will give an investor an exposure to the economies, production and the consumption growth. Various commodities are included in calculating the GDPs, inflation rates, etc. for the economy. So investing in commodity will include those in your exposure as well. Many times when economy experiences growth, the demand for the commodities rise, and as a result their prices rise, and which is a potential for earning return when you buy the commodity at a lower price and sell it at a higher price at a later date. Whereas to the contrary, during recessions, commodity prices are likely to fall because there is lack demand and lower production. So at those times, prices are likely to fall. And the ideal strategy would be to sell the commodity at that time. So these swings in the commodity prices are likely to be larger than the changes in the finished goods price, obviously because the commodity prices trade directly on the basis of the as it is state without them being converted into finished goods. When you convert those, when you process these raw materials through some processes, they are converted into finished goods and ultimately they change their form and hence the prices will be different. So the changes in commodity prices will not directly or not to the same extent affect the price changes in the finished products. Again, the primary motivations for investing in commodities is that it acts as an inflation hedge. Most of the times it is found that commodity prices are highly correlated to the inflation because the inflation calculations include the changes in the prices of a lot of commodities, especially in the food and the energy sector. So when you take an exposure in commodities, you are effectively hedging yourself against the inflation. And another motive would be to speculate on the near-term changes in the prices of the commodities and profit or benefit from those. Let's understand some of the pricing of the commodity futures contracts. Futures contracts price is most approximately near to the spot price of the commodity multiplied by 1 plus the risk-free rate plus any associated storage costs of the commodity minus any convenience yield. We'll understand these terms in some time, but just remember this formula. You should put it down in your formula sheet for the exam. So futures price is approximated by spot price of the commodity multiplied by 1 plus the risk-free rate plus the storage costs minus convenience yield. The R here represents period's short-term risk-free rate, that is the period for the futures contract. And the futures price could be higher or lower than the current spot price depending upon the convenience yield, which we'll understand now. Further, the storage cost, that is the storage cost mentioned here, plus the interest cost, that is the 1 plus R, are also known as cost of carry or the carry in the common parlance, which means you're holding the goods, which will involve storage costs, and you're blocking your money by buying the commodity or buying the future contract, which will entail an interest foregone opportunity. And now let's understand convenience yield. Very important. The buyer of a futures contract is foregoing the convenience of the physical possession of the commodity immediately until the expiry of the contract. So in case the buyer had opted for actually taking the physical commodity and buying it in the spot, he could have used it in the production process or could have used it for any other purpose. So by entering into a futures contract or by buying the futures contract, he's foregoing that convenience, and that is what convenience yield stands for. So convenience yield is adjusted for or reduced in the calculation of the futures price and is huge determinant in the direction of the movement of the futures price.